Again, welcome everyone, and good afternoon. My name is Bill Fox. Welcome to our first quarter of Beyond the Noise. Our goal at the Fox Alliance is to offer insight into big economic themes. Our topic for today is 2025 Outlook, Risks, Rewards, and Reality Check. Today we'll break down the biggest risks and opportunities shaping the economy and markets. As far as risk goes, we'll dive into inflation, recession risk, potential artificial intelligence bubble, geopolitical risks, and market valuations. On the opportunity side, we'll talk about deregulation, corporate tax cuts, S&P 500 earnings growth, AI innovation, and geopolitical resolution. Our panelists will speak for about 30 minutes, and we'll have time for questions after that. As a reminder, compliance doesn't allow us to use the chat feature. So if you do have any questions, please email me, bill@thefoxalliance.com. Our presenters today will be Max Clark, Laura Cooper, and Josh Renfro. And Max will be our first presenter. Max, take it away.
Thanks, Bill. I appreciate it. As Bill mentioned, we're going to get started with risks on the front end, and then we'll follow it up with the opportunities that we're seeing going forward on the latter part of the presentation. But to kick things off, I want to start out by talking about one of the primary risks that we see going into the next couple of years, and that is inflation. Inflation has been a hot topic over the last, call it 4 to 5 years. And what this chart looks at is over the last, really back to 1974, you can see headline and core inflation. Headline would be all inflation. Core inflation, which is the black line, would be headline inflation minus food and energy. They take that out in the core inflation because food and energy can be a little bit more volatile. You can see that blue line is a lot more volatile than the black line. But what I want to focus in on here is really the last 5 years. You can see that inflation was hovering around 2%, call it 1.5%, 2% for quite some time following the 2008 Great Financial Crisis. And it shot up in connection with COVID. You guys probably remember us hitting almost 9% back in June of 2021. It has obviously significantly decreased since that time period, and we're hovering right around high 2s, 3% roughly. Going forward, though, the Fed's objective has been to see inflation come down. We are not convinced that that will play out. There are several factors influencing inflation that we think could really put some upward pressure on inflation. 3 in particular, and we want to dive into each of those now. The first is tariffs. So we know that tariffs have been a big objective or a big policy objective of Donald Trump as he enters his second term here. And tariffs are really being implemented pretty heavily right here at the beginning of his term. There are a couple of key decisions that he's made. The first is with regard to Canada and Mexico. So if you look down here in the lower left-hand corner, you can see a 10 to 25% tariff on imports from Canadian goods. Specifically, it's all goods are going to receive a 25% tariff with the exception of energy. Energy is going to receive a 10% tariff. Mexico, on the other hand, all of their goods coming into our country receiving a 25% tariff. You guys probably know this from past experience, but Trump has primarily used tariffs in the past as a bargaining chip, as a tool to get other countries to do what he wants them to do. Well, we've seen that certainly be the case here with Canada and Mexico because he announced these tariffs. Mexico and Canada complied in his request to have their help with the border security. And now he put that on pause for 30 days. So we'll see if those actually ultimately get put in place. But for now, they are technically supposed to take effect probably in the next couple of weeks. If we shift over to China, Trump also added an extra 10% tariff in addition to what is already in place on imports from China. So that bumps the total China tariffs up to about 17.5% to over 30%, depending on the particular good that is being imported. And then the last thing that he's done recently is he added an additional 15% tariff on all steel and aluminum imports. This is, as he describes it, an effort to promote national security, ensure that we have these essential goods being produced here in the US. We import somewhere between 25 and 45% of our steel and aluminum from external sources. So that represents a pretty meaningful amount of steel and aluminum that would experience that tariff. It's also important to note that that tariff of 15% is on top of any other tariff that is being imported. So about I think 40 to 60, I think 40% of steel, 60% of aluminum comes from Canada and Mexico. So if we already have a 25% tariff there, you add on top of that another 15% tariff for steel and aluminum, we could be looking at about a 40% tariff on the steel and aluminum. Now let's step back and think about how this would impact our economy at a higher level. If you take a look at the total amount of imports that are coming into our country from these three countries, Canada, Mexico, and China, upper right-hand corner, you can see that this represents roughly 40% of all U.S. tariffs, or sorry, all U.S. imports. And that totals about $1.4 trillion. So if we are adding essentially a 10 to 25% additional tax on all of those imports, about 40% of U.S. imports, there's hard to imagine a scenario where that does not create inflation. Harvard estimates that Hartford, one of our investment partners, estimates that we could see impacts on inflation of about 0.5% increase due to these tariffs. And that does not surprise us. Given the numbers here, that seems very reasonable. There's also a longer term risk here where if we end up getting into some sort of trade war, right? If we say, all right, we're putting a 25% tariff on Mexico, Mexico says, all right, well, we're going to match you and make it 30%. And then Trump raises it up to 30. We could end up getting into kind of this long-term trade war, which increases the pain associated with this inflation, upward pressure on inflation. So tariffs is the first concern of ours that we're keeping a close eye on, and assuming they all get implemented, it seems likely that we'll see some inflationary effects from that. Now, the next category or the next factor influencing inflation going forward is deportations. So another one of Trump's tenets is deporting first the illegal immigrants that are criminals and have a criminal history, but then secondarily deporting all illegal immigrants that aren't in this country legally. And we're not commenting on whether or not we agree with that policy. But what we are looking at is if that were to take place, how does this ultimately impact the economy, specifically with regard to inflation? So effectively what's happening there is we have about 13.3 million illegal immigrants in the U.S. currently, based on best estimates that we have. Could be more than that, certainly. But that's the best estimates that we have right now. Of those, not all of them are working age and are in the workforce. But if we were to take a look at the known illegal immigrants in the workforce, we've got probably about 4.5% to 5% of the U.S. workforce is in that illegal immigrant category. So if we end up deporting about 4.5% to 5% of our workforce, especially those workers that are on the lower cost end of the spectrum, we put ourselves in a position where it's going to be difficult for construction, agriculture, hospitality to backfill those with other American workers or legal immigrant workers at the same cost. So that's very likely to cause an increase in inflation going forward. There's a possibility that could get offset by streamlining the immigration policies of this country, but I've not seen anything move through Congress quickly in my history. So I think it's likely that that doesn't happen immediately. As I mentioned earlier, this is most likely to impact particular industries. Construction, for example, almost 14% of that workforce is made up of illegal immigrant workers. Agriculture is the other big one, made up of about 13% illegal immigrant workers. Another thing to note, California, Texas, and Florida host almost 50% of all total undocumented immigrants. So what that means is if we end up seeing a lot of these deportations occur, it is likely that California, Texas, and Florida would experience the most pain from that from an worker shortage standpoint. So again, deportations, in our opinion, assuming it actually plays out the way that Donald Trump is wanting it to play out, is very likely to create upward pressure on inflation. The last risk here or factor influencing inflation in our mind is tax cuts. Now, generally speaking, we're free market people and believe that tax cuts can be a valuable tailwind to the markets. But I think when we're talking specifically about inflation, tax cuts do have the potential to increase inflation going forward, which is one of the biggest risks, in our opinion, as we look forward into the future, a reignition of inflation. So if we look at Trump's proposals, he's looking to extend the Tax Cuts and Jobs Act. We had a presentation on this a couple, 3 to 6 months ago, and those tax cuts were the income tax cuts that were put in place back in 2018, 2019 that are set to expire at the end of this year. He'd like to extend those. He'd like to provide SALT relief, which is basically give people deductions for state and local income taxes or state and local taxes. He wants to eliminate taxes on tips, overtime pay, Social Security, and domestic production. So what that does is when you cut taxes, that frees up cash flow in the budgets of individuals. And ultimately, what that means is it increases demand for other products and services in the country. Oftentimes, though, when you simply cut taxes, it does not necessarily equate to an increase in supply at the same time. So if you're increasing demand for other goods and services in the country, that likely leads to inflation. Again, just some additional upward pressure on the inflation side of things. So we've got tariffs, deportations, and tax cuts, all likely upward pressure on the inflationary side of things. And I think if you look at the Fed's longer term projections, you can see they're adjusting to this mindset as well. What we have here is the unemployment rate, the headline inflation, the core inflation, and then the federal funds rate. These are their projections for 24, 25, 26, 27 in the longer term when they had their meeting back in middle of December a couple of months ago. The blue lines here are what their September projections were. So it's interesting to see how they've made changes just over the course of the last quarter. You'll see that for 2024, they hadn't quite finished that year yet when they had that meeting, but you can see their projection for inflation in September was 2.3. They revised that to 2.4. For core inflation, 2.6, revised that up to 2.8. Look further down the road, 2025, revision up to 2.5 from 2.1. You can see they're actually thinking that headline inflation will actually go up over the next year, not come down. Core inflation up about 0.3%. It doesn't kind of get back down to their 2% target until 4 years out, 3-4 years out. So what that necessitates really is we're not expecting a lot of interest rate cuts in the coming year. Neither is the Fed. Now, I will say we don't put a lot of credence in the Fed's projections, but I think what is interesting to note here is that the Fed is also expecting inflation to be a bit higher going forward. So that's the first risk, the inflation side of things. I'm going to pass it over to Laura to discuss the next risk that we're covering here. Laura, go for it.
Awesome. Thank you, Max. All right. I'm going to start off with touching on probably one of the biggest questions that we get as financial advisors, which is what is the risk of recession? So this chart here shows market recession odds, which are represented by the blue line here. And then the actual recessions represented by the gray boxes. So right now, the market recession odds are about 10%, meaning that the risk of recession currently is pretty low. To Max's point, the biggest risk that we have right now for a recession is inflation ticking up and the Fed's response to that inflation being a really rapid rise in interest rates. If we do see that, which we have seen multiple times in the past by the Fed in response to inflation, then we could see a recession follow. But as things currently stand, given the current economic environment, the risk of recession is pretty low. The third risk that I'll discuss is the risk of some sort of artificial intelligence bubble. Amara's law states we tend to overestimate the effect of a technology in the short run and underestimate the effect in the long run. I think a great example of this is using the internet, which the dot-com bubble was the last technology-based market bubble that we saw in 1999, early 2000s timeframe. And really, if you think about what happened during that period of time, the 1990s, as we started to launch the internet, saw a massive amount of exuberance and greed, quite frankly, to try to take advantage and get ahead and invest in this technology that was expected to change the future. And it did change the future, but it also led to a bubble in the internet space. The result of that bubble, once it popped, was a 90% drop in the NASDAQ 100 and 3 consecutive negative years in the S&P 500. So even though the internet had an absolutely revolutionary change, we did see exuberance that led to a bubble. And so the question is are we going to see something similar with artificial intelligence? If we look on the left here, what this graph shows is capital expenditures for the major AI hyperscalers. So this includes Alphabet, Amazon, Meta, Microsoft, and Oracle. In 2023, combined, these companies spent about $126 billion in capital spending. The expected spending for those companies over the next 3 years is expected to explode. 2024, that number was $198 billion. And for 2025 and 2026, $238 billion and $254 billion. That's a lot of money. The concern here is not necessarily the amount of money spent and invested, which is pretty significant. It's the lack of revenue that we've yet to see be actually generated from that spending. So if we don't see that revenue starting to increase over a commensurate amount of time, that is a pretty clear sign that you're starting to head into what could be considered bubble territory. I think what's really interesting is this graph on the right here, which represents the S&P 500, which is the gray line here in the middle. The S&P 500, if you take out the Magnificent Seven stocks, which is the blue line, and then the Magnificent Seven stocks, or the Mag 7, which includes Apple, Amazon, Alphabet, Meta, Microsoft, NVIDIA, and Tesla. Over the last 3 years, 50% of the S&P 500's returns have come from 7 stocks, the Mag 7. The Mag 7 represents, from just a number, about 1.5% of the index. So 7 stocks is 1.5% of 500. Pretty significant. That's pretty crazy. What the concern here is, what happens to the rest of the index if the Mag 7 does not perform? And for 2025, we've seen that kind of have a negative effect, that there's been a negative 4% correlation between the S&P 500 and the Mag 7. But this is really interesting. I think this will be fascinating moving forward to see if the Mag 7 actually continues to have such a large share of returns when it comes to S&P. And if that continues, if that leads to some sort of artificial intelligence bubble. So with that, I will turn it over to Josh to finish out the risk.
Thanks, Laura. Real quick, one just clarifying point. Magnificent Seven as a percentage of the S&P is 1.5% of 500. It's, I think, close to a fourth of the total dollars that are put into the S&P. On the geopolitical risk side of things, we've got really 2 major theaters of conflict right now in the Middle East, predominantly with the Gaza engagements, as well as the straits with the Houthis. And then we, of course, have the much larger conflict between Russia and Ukraine. So these conflicts could ultimately either continue to be as challenging or could even spread. One of our concerns last year was that the Middle East war might broaden into a broader conflict. as tensions between Iran and Israel seemed to pick up. And so that's still a real risk. At the end of the day, while it looks like there may be some negotiations that could bring to a peaceful resolution, those have not happened yet. And until it does, risk of a more escalating conflict is something that's always on the horizon. Similar thing with the Russia-Ukraine war. And then finally, China and Taiwan. At the end of the day, this is always still a considerable risk. China has made their opinions on Taiwan very clear. And so the question is this something that could ultimately materialize? So while we would argue that these are tail risks, they're not risks that we think are highly likely. We do think that these are risks that, if they were to occur, would have an outsized impact on the broader markets. And that leads us, honestly, to, in my opinion, one of the top two most concerning risks, which is the actual market valuations, or another way of putting that is just how expensive is the stock market today? So one of the concepts we talk a lot about with our clients is this concept of price to earnings ratios, which is simply a way of measuring how expensive things are. And so we've done an illustration here just to kind of reiterate how do we actually determine what a price to earnings ratio is. So if we look at a Starbucks that made $100,000 of profit, and let's say Laura was willing to buy that Starbucks from me for $1 million. Well, that Starbucks would have a price to earnings or price to profits ratio of 10, because she'd be willing to pay 10 times the profits in order to purchase it. Let's say that the situation was a bit more competitive and Laura had to go up to $2 million. If that was the case, the price to earnings ratio would be 20, because she's willing to pay 20 times the profits for that business. So the question, of course, is what kind of situation are we in with the markets today? And the answer is, when we look at this ratio, which is called the Shiller PE ratio, this is a cyclically and inflation adjusted price to earnings ratio. This is specifically for the S&P 500, and it goes back starting in January of 1871 to today. If you look over that time frame, the average price to earnings ratio has been 17.2, meaning in our Starbucks example, people have been willing to pay $1,720,000 for a company that generates $100,000 of profit. Even most people are like, well, that seems expensive. Why would people pay that? Well, one, we're usually dealing with larger businesses. And two, we're usually dealing with businesses that are monopolistic in some way. There's a moat around what kind of business they operate. It's harder for people. And then finally, they oftentimes can have higher than normal growth rates. Well, today, we're not at 17.2. You can see here at the chart, we're at 38.54. And the correct response to seeing that is wow, or yikes, or that seems concerning, because that is the third highest that ratio has been in the last 150 years. And I hesitate to say the third highest, because on a day-to-day basis, it rotates between the second and the third, because the second highest was in October of 2021, where we were right at like 38.6. So we're like literally 0.06% away from being tied with the second highest. And of course, we know what happened after October of 2021. We saw the S&P drop at its peak 27, the NASDAQ about 55, and bonds had its worst year since 1842. The only other period where it was substantially more than that was the dot-com bubble, which Laura referred to earlier, where the S&P was down 50% over that 3-year period of time. And also the NASDAQ was down over 80%. So let me be clear about what we are not saying. We're not suggesting that you sell all of your stocks, go to cash, and then bury it in the backyard. But what we are suggesting is that this is a time where we tend to believe that investors are getting paid less to take larger amounts of risk, and that being more cautious is a more prudent course of action. So anyways, that's one of the two larger risks that we see this year. And with that, we'll transition back over to opportunities and turn that back over to Max.
Thanks, Josh. I'm going to start out with our first opportunity here, which is deregulation. So we're shifting gears from focusing on the things that we think are going to be headwinds to the markets and to the economy, and shifting over to those that we think will be tailwinds and potentially be positive for the markets going forward. One of the biggest ones that we see is the potential for deregulation. That's been a big driver of the Trump administration and his efforts with the Department of Government Efficiency. And we'll see how all that plays out. But to give a little background here, a little context to the regulations that we have here in the United States, our Code of Federal Regulations, which is basically the storage place for all federal regulations, is over 188,000 pages long. That is hard to comprehend, honestly. And in order to comply with that, it's estimated on the conservative side that it costs Americans, either corporations or individuals, about $2.1 trillion annually to comply with these regulations. Put that in the context of each household. It costs each household almost $16,000 a year to have these regulations in place. Now, I'm not suggesting that all regulations must go. There are obviously a lot of regulations that are in place that are necessary and important, but I'm guessing there's a lot of regulation in that 188,000 pages that is unnecessary and could result in a deregulation or could be deregulated and therefore result in some benefits to our country and our economy. There's been some research done that suggests that in industries where meaningful deregulation occurs, you can see a decline in prices. We're talking about inflation being a problem going forward, but if you see deregulation, you can actually see about a 30% decline in prices in connection with deregulation, with the potential increase in economic growth of about 3%. When we're dealing with a baseline of 2.5 to 3 percentage points of GDP growth right now, an extra 3% is a meaningful increase. So deregulation certainly has the potential to be a real tailwind for the economy and the markets. The second would be corporate tax cuts. We were talking earlier about tax cuts potentially being a contributing factor to inflation, which that's certainly possible. But I think on the opportunity side of things, we're specifically talking here about the corporate tax cuts. One of the most valuable areas when you're looking at improving economic activity and competitiveness around the world is your corporate tax rate. And prior to the Trump tax cuts back, which was TCJA, the Tax Cuts and Jobs Act that was passed back in 18 or 19, we had a graduated tax system for the corporate tax rate, which meant that there were various brackets, very similar to the income tax brackets that we have today. At that time, the highest bracket was 35%. And as a result of the TCJA getting passed, those rates were cut to just a flat percentage of 21% for all income from corporations. The proposal from Trump's administration is that we reduce that even further by another 6% to 15%. That would put us only ahead of about 3 or 4 countries in terms of the lowest tax rate in all of the world from a corporation standpoint. And that puts us in a real competitive position globally. The research suggests, this is from the Tax Foundation, that could have an increase in long-run GDP by about 0.4%, increase in long-run wages, meaning that we could see an increase in wages for workers of about 0.4%, and an increase in jobs of about 93,000. So again, just another factor that we think could be a real tailwind for us going into this next year. I will wrap up there and turn it back over to Laura to cover the next couple of items.
Perfect. Thank you, Max. All right. The third opportunity here. Whoop. If we can get technology to work for us. There we go. Third opportunity here is earnings growth. So this chart is from JP Morgan, but this is a consensus estimate, just meaning that it's a combination of what all of Wall Street thinks as far as what we're expected to see for earnings growth in 2025. Large cap here, which is the dark gray box, think of that as the S&P 500, expected to have earnings growth of about 14%, which is really strong and stronger than what we have had in the last 3 years. So even though valuations are high, as Josh mentioned, and they are historically very, very high, Earnings growth is expected to pick up and continue to be impressive going into 2025. What's really impressive here is the small cap earnings growth at 45%, really expected to pick up starting in the second quarter of 2025. So that's something that as an investment committee, we've really had an eye on. I think it'll be interesting to see if anything changes. Again, if we do see some of those risks come into play, like inflation and some of the other risks that we discussed, that has an effect on these earnings growth projections. But for right now, it's expected to be a pretty strong growth opportunity. The fourth opportunity here is actually AI innovation. So this goes back to Amara's law, as we discussed. In the short run, people seem to overestimate. In the long run, they can actually underestimate. And this would be an example of an underestimation where AI becomes an opportunity. It's expected that by 2030, $15.7 trillion will be contributed to the global economy via AI. Right now, the global economy is about $110 trillion. So it's about a 15% contribution, 15% of the global economy contributed via AI, which is pretty impressive. And also 0.5 to 1.5% increase in US GDP over the next 10 years. So not insignificant when it comes to the effect that it can have, not just on the US economy, but globally. And this is really achieved by a decrease in cost and an increase in productivity. This is one of the biggest, this can be one of the biggest benefits of AI, is that if we can increase productivity across the board, therefore decreasing cost and leveling out prices across the global economy, that could have a huge impact. AI can have a huge impact in helping to do that. So I'll turn it over to Josh to finish out the last couple of opportunities.
Thanks, Laura. As you can notice, a lot of these opportunities and risks are two-sided swords. And so geopolitical resolution is one of those other areas. Specifically, the one that we believe would have by far the largest impact would be the Russia-Ukraine war. Some of the inflation we've seen in food and oil and gas prices have been much more significantly contributed to by that war. And so if we did see that war ultimately come to a peaceful resolution, it's likely that that would have an outsized impact, and really specifically on the inflationary environment overall. So that's one of the other areas where there's some opportunity. And then the last area is in the mergers, acquisitions area, and I would also add IPO market. We have seen 2 years now where mergers and acquisitions have been a good bit lower than historical averages, averaging close to about $2 trillion versus the standard number of kind of $3 to $3.5 trillion. We do believe that there's a likely chance that that will pick up this year, predominantly driven by a couple of factors. First, the new administration is much more favorable to mergers and acquisitions. There was very few large or even medium-sized acquisitions and mergers that were approved by the FTC overall. And so that is expected to change under the Trump administration. The second piece is just overall improved sentiment. There was a lot of businesses that ultimately decided to postpone sale simply because they didn't feel good about the environment. And I would also add to a third reason, which was as interest rates moved up, the multiples that people were willing to pay for businesses declined. And so in order for people to get the same price, they had to wait for the profits or the revenue to catch up. And so over the last 2 to 3 years, we've continued to see good, strong revenue and profit growth, at least on a more broad-based scale. And then regulatory improvement would be kind of the final area. I can tell you just anecdotally, we have seen from the private equity community anecdotes of an uptick in M&A activity. We'll have to see ultimately if that ends up materializing, but we've seen some good anecdotes so far. And then the other area that's been really interesting is we've also seen an uptick in the number of companies that have filed to go public. It doesn't mean that they will go public, but they're at least exploring and seriously exploring and getting ready to do so if it looks like the opportunity will remain. And so that's kind of the last area. So I want to take everything we've discussed here and really try to crystallize it down to a final couple of points. our base case for this year is that we expect the markets to overall have a good year. Back to Laura, one of the points that Laura mentioned, profit growth this year is expected to be quite strong. So now in our opinion, there are two risks that have a larger opportunity to affect that. The first of which is inflation upticking, and as a result, seeing the central bank be forced to raise interest rates in response to that. That can oftentimes usher in a recession, and we've seen that multiple times in U.S. history. And then the second big risk is the fact that we do have a very expensive stock market. If we ultimately had some kind of catalytic event that started a panic and that caused the sell-off, we could see, despite having strong earnings growth, the stock market take a turn for the worst. And so those are really the two risks that we're watching very closely. But provided those two risks don't materialize, our belief is that we will likely have a pretty good year, at least from a stock market standpoint. And so with that, we'll go ahead and wrap up today.
Okay, we have one question at this point. This is regarding Laura. The question is, Laura showed small caps have tremendous growth in 2025. What is behind the growth and what is driving this growth?
Yeah, that's a great question. I think there's a few factors. One, as Josh mentioned, in 2022, we saw a very significant decline in the markets due to a rise in inflation and a subsequent rise in interest rates. Small caps were, even though all publicly traded companies were affected, growth companies and small companies were pretty significantly affected. We saw, drops of anywhere from 25 to 45% in prices. And over 2023 and 2024, those larger companies recovered pretty nicely, to the point where now we're at the valuations of, again, being back to the third highest. Small cap companies have not recovered as well as large companies have. And in fact, where large companies are trading at the third highest valuation, small cap companies across the board are trading under their historical averages. So the expectation is that as rates continue to either come down or stay flat over the next 12 to 18 months, that small companies can then benefit from the recovery that large companies had over the last couple of years. So that's really the biggest growth factor. Again, going back to the point that I made earlier, if for some reason we do see inflation tick up and that calls for higher rates or even an increase in rates drastically, obviously I think that those profit expectations will change. But for right now, given the base case of what we've seen in the economy, that's what's expected to drive small cap growth.
All right, thank you, Laura. Well, that's all the questions that we have at this point. Thank you to our presenters, Max, Laura, and Josh. Have a great rest of the week, and we look forward to seeing you at the next Beyond the Noise webinar. Have a great day.